WACC, WACC, weighted average cost of capital, is the minimum return a firm must earn on its existing assets to maintain the value of its stock and to satisfy its investors, including stockholders and bondholders. So today we want to compute WACC or WACC, or weighted average cost of capital. But before giving you the example, let me show you what it means. So a company's assets may include, so this is total assets of the firm. So it may include, it depends on the capital structure of the firm, it may include bonds or debts. Yeah, so company to raise capital, a company to raise capital may issue bonds, means they borrow, and they may issue also stocks. And the stocks, they have two types. One is common shares. So here I write equity or common stocks. And they may issue preferred stocks, right? Okay. We already have discussed bonds and stocks, and we know how to compute the bond price, stock price, and we know how to compute the return on bonds and stocks. This means that we already have seen how to compute the yield to maturity for bonds. Means if you buy a bond, then what will be your return? As you remember, there were 5 parameters. If you don't remember, please have a look at the topic on bonds. So there are 5 parameters that you need to include in the calculation for bond price. To compute the bond price, which is the first parameter, you need to have future value, interest rate or yield to maturity, and you need to know the coupon rate or the payment, the fixed payment, and also number of periods, right? So these are the 5 parameters. But here, actually, we want to talk about the interest rate. So we will have the other 4, and we want to compute the 5th one, which is the interest rate or yield to maturity. So you already know how to compute the interest rate or yield to maturity. It means if you buy a bond, how much you will earn. And actually today there is nothing new in terms of the formula. So we will use the same method to compute the interest rate. But today we will name it cost of debt. Why do we name it cost of debt? Because today we will look at the same thing from the company's perspective, from the company's point of view. So previously, in previous topics, when we were talking about the bonds, we were talking at bonds. We were looking at bonds from the investor's perspective. We wanted to know if you buy a bond, what will be your return, how much you earn if you buy a bond. So these return, these earning, these interest that you will receive if you buy a bond is actually a cost for the company that issued the bond, right? So as an investor, you will earn some interest when you invest on bonds, but for a company is a cost. So the company borrows money from the investors, and the investors will earn interest. And this interest is a cost for the firm. And we name it cost of debt. Cost of debt. So today we want to compute cost of debt. So it's the same thing, right? It's the same thing. It's actually interest rate that we already computed, but we name it cost of debt because today we want to look at the same thing from the company's perspective. For stocks, it's the same scenario as well. We already have seen how to compute the interest rate, your expected return on stocks, right? When you buy stocks, we know how to compute the expected return. There were some methods, 2 of them were capital asset pricing model and the dividend growth model, the most commonly used methods. And you can use, we actually already use those formulas to compute the interest rate on stocks. It means if you buy a stock, you can compute the expected return, right? If you want to buy a stock, you can compute the expected return. These already have been discussed in previous topics. We will use the same method And we will compute the interest on stocks, but we name it cost of equity because we want to look at it from the company's perspective. So when you buy stocks, you remember the Gordon model formula? For the Gordon model formula, we discounted the future cash flows to the present time using a formula that assumes that there is a constant growth rate. So those dividends are the cash flows. So those cash flows, those dividends that you received were discounted to the present time, and that was the price, right? So using that formula, we could compute if we buy this stock, what will be my interest that I receive, what will be my earning, how much I earn, maybe 10%, 15%, 20%. It's the same as required rate of return or interest rate, right? So we already know if we buy a stock, what will be our expected return, how to compute. So we do the same calculation and we name it cost of equity because we are looking at this from the company's perspective because what you earn is the cost for the company. The same thing for preferred stocks. You can compute the earnings on a preferred stock if you buy it. Now we name it cost of preferred stock because this is a cost for the company. So today's topic is we will look at the same topics, same things we already discussed, but from the company's perspective. And we name it cost of debt, cost of common stocks, cost of preferred stocks, and this part is cost of equity. So why we are interested to know what's the cost of bonds, cost of common stocks, cost of preferred stocks, or cost of capital, right? So because suppose a company wants to go for a new project, right? So they will use their assets for the new project or for future growth or for whatever, right? So when they want to go for a new project, they need to know how much they must earn, what's the minimum required rate of return for the company to be able to pay the interest on the bond, to satisfy the stockholders. And this is the reason that we need to know the minimum return that the firm must earn on its existing assets, right? For example, when a company goes for a new project and for example, the average return they need to earn to pay to the stockholders and bondholders, suppose the average return, which is called WACC or WACC, the average return is 10%, and then but the new project, the earning on a new project will be just 5%. So the company won't accept it, right? So this is very important. This is actually the required rate of return, the minimum required rate of return a company needs to earn to satisfy the bondholders and stockholders, right? Otherwise, they won't be able to pay to the bondholder. They won't be able to pay the interest to the bondholder. They won't be able to satisfy the stockholders. So this is the minimum they need to earn. And this is called the weighted average cost of capital. So we need to make sure we satisfy all people who invested in the company. So when we go for a new project, we need to make sure we earn enough to satisfy our investors. So for bonds, you remember there were 5 parameters to compute the yield to maturity or interest rate. So we want to do the same thing. So there were 5 parameters. I just write them here. Future value, that's in these cases we assume we don't sell the bonds, so it's the par value or face value. And then you need to know the PMT, means the coupon payments, and you need to know the price of the bond, and you need to know the number of periods. So these are the 4 as you remember, these are the 4 parameters you need to key into your financial calculators, and then you compute the interest rate. So it's the same thing, right? If you have a look at your bond topic, you will see it's the same thing we already have seen. But here we just name this as cost of debt. So here this is cost of debt. What about preferred stocks? For preferred stocks, you remember what was the formula? So preferred stocks, I write it here. The formula to compute the price of preferred stocks was dividend divided by interest rate, right? So, or required rate of return. So required rate of return is dividend divided by price. And this is cost of preferred stocks. So it's the same thing we already have seen. I just named it cost of preferred stocks. And then the last one for equity, common stocks, I write it here. So we used two methods, right? One was expected return on a stock is risk-free rate plus beta market return minus risk-free rate, and this term RM minus RF is called also the premium, risk premium. So this is the capital asset pricing model, right? Capital asset pricing model. I just write the name here, capital asset pricing model. There was another method. Actually, there are different methods, but I'm here using the most commonly used methods. The other one was Gordon growth model, right? Dividend growth model. So the formula was price was next dividend divided by R minus G. And here we are interested to compute the required rate of return or interest rate. So I bring this R here. R, you bring it here. So it will be D1 over price plus G. I bring this here, P0 here, and then G to the right. So this is the Gordon model, right? We already have discussed this. And okay, sometimes you have the information to compute the expected return using capital asset pricing model, means you have risk-free rate and beta and market return. Sometimes you have the next dividend and growth, constant growth rate, then you may use this one. Sometimes you have the information for both of them, then use both and then compute the average and use that one as cost of equity. So we know how to compute cost of debt, we know how to compute cost of preferred stocks, and we know how to compute cost of equity. So the next stage is to compute the weighted average cost of capital, means the weighted average of all these costs. We have 1, 2, and 3 costs. This one is the equity. So in some firms, the bonds may be more. In some firms, equity may be more. Some of them may be it's balanced. So we need to know, we need to know when we want to compute the overall cost, we need to apply the weight of these components, right? Because their cost won't be the same. So the cost of equity may be more than cost of debt, and in a company maybe debt is more, in a company maybe debt is less. So now to know on average how much we need to, what's the minimum we need to earn to satisfy all stock and bond holders, we need to apply the weight and compute the weighted average cost of capital. And the formula for weighted average cost of capital is just we apply the weight to these costs. So let me write it using exactly the formula that I have included in the slides, the same parameters. So WACC or weighted average cost of capital, you may write it as, so here this is, I name it cost of equity. This one I name it cost of debt. This one I name it cost of preferred stocks, right? RD, RP, RE. So it's cost of equity and then the weight of equity. Here, suppose is the weight, I name it E. This one, the weight, the size, the size of debt, maybe $1 million, $10 million, I name it D. This one may be $20 million. I name it. I use E to refer to it. And here, let's name it P. P. So these are the size. And V is E plus D plus P. Means the total asset size. Total asset size means this one plus this one. So in a company, maybe $10 million equity, $20 million debt, and $2 million preferred stock. So 10 plus 20 plus 2, right? And this will be the total size. Now, what's the weight of E? E divided by total size, right? So I just write like this. So this will be cost of equity, then the weight of equity plus cost of preferred stocks, then multiply by weight of preferred stocks plus RD, cost of debt, multiply by weight of debt. But here I need to add one more term, 1 minus tax, because debt is tax deductible. Means there is a you need to deduct this the benefit for the tax because it's tax deductible. So this means less cost for the firm, right? So the cost will be less. How much? You need to apply this tax, which can be 30-40%. So then you compute this, and this is WACC, or weighted average cost of capital. So if you do the calculation and suppose the WACC is 10%, then you know when you go for a new project or any new investment, you know you need to earn at least 10% to satisfy all stock and bondholders, all investors who invested in the company. So this is WACC.